Strategies with a reverse mortgage, part 2, and why it's a must for every Canadian investor so that they can buy more properties. Last week, I talked about the basics of a reverse mortgage, part 1. If you want to hear last week's session, just comment below and I'll send you the YouTube link. Hello, lazy landlords. My name is Sylvia Ho, and I'm a financial landlord consultant. I work solely with landlords to help them save money in the amount of income taxes that they pay and decrease the interest that you pay to the banks. And then you take those savings and you pay off your home, your owner-occupied home mortgage 8 to 12 years earlier than planned. So reverse mortgages. In each scenario that I'm going to share below, let's back up. In each scenario that I share below, you don't have to have a house that's free and clear. Okay, you can have a mortgage debt against your home and still get a reverse mortgage. But for simplicity's sake, in all the scenarios that I'm going to talk about below, I'm going to assume your house is free and clear. All right. So most of our retirees or senior citizens are house rich, cash flow poor, meaning they worked their butts off to pay off this mortgage debt that they owed, and they're now living in a house with no mortgage. They have a house that's free and clear, house rich. A reverse mortgage can help you tap into that richness or the equity that is in your home. And the best part is you don't need to qualify for it. Remember, getting a regular mortgage where you must make regular mortgage payments each month, you have to qualify. So if you make $100,000 a year gross, the banks will lend you 4 to 5 times your income. That means they'll give you, say, $500,000 mortgage, but you have to qualify for it and you must make monthly mortgage payments. But with a reverse mortgage, they don't rely on your income. They don't rely on your income. They base your lending, they give you money based on your age. The older you are, the more they'll lend you, up to 50 to 55% of the value of your home. So you can make $30,000, which is what the average CPP and OAS, which is $1,500 per month. I can't imagine living on $1,500 per month, but let's just say you're making $30,000 a year from CPP and OAS and you don't have a pension. Your house is worth $1 million. You're over the age of 80. They'll lend you, these lenders, reverse mortgage lenders, will lend you $500,000. Now, the younger you are, the less money they'll lend you. So if your place is worth $1 million and you are 55, they'll lend you between $150,000 to $200,000. Now, before I talk about the different scenarios, please, if you like the information that you're getting in my videos weekly, please like it. Please comment below if you've learned anything so that this encourages me to make more videos for you each and every week. All right, let's talk about the different scenarios. Scenario number 1, you're between the age of 70 to 80 years old. Automatically, they'll give you anywhere between 45 to 55% of the value of your home. So let's just say your house is worth $1 million. They'll give you $500,000. This money is literally deposited into your bank account. Boom, $500,000 in your bank account, and you can do whatever you want with it. You can go on vacation, you can travel around the world, you can spend it for everyday use, or you can go buy another property. Now, at age 70 to 80 years old, you probably don't want to manage a rental. You don't want to manage a tenant. So an option is to gift it. Gift it to the next generation. Help them. Help your kids buy a rental property. Give it to them as an early inheritance. Or even your grandkids. Maybe you have grandkids and you've been blessed with grandkids and they're going to university for the next 4 to 8 years. Buy a property for them in this university town. Give it to them as an early inheritance. So let's just say you have 2 kids. You give each kid $250,000 because you've been deposited $500,000 into your bank account. Each kid will have $250,000 go. The kid will now go buy a rental property. Now, as a parent, you can see the benefits of this early inheritance before you pass. Because as parents, everything we do is for the kids. So why not give them the money while you are living? And the beauty about all this is that you don't get taxed on debt. So when you pass, you will pay less death tax. And then, of course, since the kids are buying a rental property and they're likely already own the primary home and it has a mortgage, we're going to apply the strategy of rental cash stemming. Rental cash stemming is an advanced financial strategy only for landlords where you can save on the income taxes that you pay the government every single year and save on the interest you pay the banks for your mortgage. And with those savings, you redirect it towards your primary home mortgage and pay your home mortgage 8 to 12 years earlier than planned. I specialize in rental cash stemming. I'm the rental cash stemming queen. So if you have any questions about how rental cash stemming works and how you can apply it to your landlord portfolio and you want to learn more, comment webinar below. And I'm going to send you the 1-hour training that goes through the exact blueprint on how to do rental cash stemming. Now, in my training, I make it sound like a push of a button, but it's a little bit more complicated than that. So once you watch the webinar, let's chat, book an appointment with me. All right, next scenario. You're between the ages of 60 to 70 years old. You likely just retired. You probably don't have a mortgage on your home. You're living the best days of your life and you are traveling. You're spending time with family. You are seeing all the different places in the world, spending time with family, spending time with friends. And if you've been blessed with grandkids, spending time with your grandkids, right? You live in this big house, huge house that your kids grew up in. Your kids have moved out. They have their own family and you manage a house on your own. It's a big house. It's a big yard. There's lots of maintenance. Things are falling apart. So then you decide to downsize and sell and go buy a smaller place. Likely you'll want to buy like a bungalow or maybe a condo. Now, if your house is worth $1 million, for you to buy a similar place in the same area where all of your friends are, where your doctor is, where your church is, where your family is, it's probably going to be around $800,000 to $900,000. It's pretty much going to be a lateral move. And then what that means is by the time you buy this place for $800,000 to $900,000, by the time you pay your land transfer taxes and your legals and your realtor commissions, you're left with nothing. Instead, what I'm going to tell you to do is do a reverse mortgage on the home and take out that money and go buy your condo or your bungalow. Live in the downsized room, the downsized house, the smaller house in the neighborhood of your choice to be close to your family, your friends, your church, your doctors, and rent out your big $1 million home. Get $5,000 per month. Now you can live on that rental income and go travel the world and still get your CPP and OAS and enjoy your life. Yes, you're going into more debt, but you'll pay less death tax at the end. And the beauty about all this is because it's a reverse mortgage, you don't have to make mortgage payments, so it won't affect your cash flow. So my recommendation is don't sell. Instead, buy another place that you're going to downsize into, rent it out, and go travel the world. Now, if you're 60 to 70 years old and you don't want to deal with tenants, that's fine, no problem. Hire a property manager. All you're going to see is money being deposited into your bank account. All right, strategy number 3. When you are 55 years old, which is the minimum age to get a reverse mortgage here in Canada, you'll likely still be working and making good money, but you don't quite qualify to get another mortgage for a rental property. But your house has a ton load of equity. That your house, let's just say your house is worth $2 million and you have a mortgage of $400,000. You can start planning for the future and buy that future retirement home, that condo, that bungalow that you're going to move into. But in the meantime, rent it out until you're ready to downsize. Don't sell. And then later on, when you're ready to downsize, don't sell your big $2 million home. Move into the other place, the downsized home, and rent out your big house. Your big house is worth $2 million. It could probably rent for $8,000, $9,000, $10,000 per month. This is the same concept as the 60s and 70s, but the advantage is you buy the second home at today's pricing, not the pricing in 10 years, because we know the longer we wait to buy something, the more expensive it costs. So my friends, My lazy landlords, that's three different ways that you can add a reverse mortgage to your arsenal and become a landlord or even expand your landlord empire. If you would like to know how this can apply to you, comment me below. Say, Sylvia, I want to learn more about reverse mortgages and how this can apply to my scenario. Let's get onto a Zoom call and let's chat. Thank you so much for listening, everyone. My name is Sylvia Ho, and I'm a financial landlord consultant. I work solely with landlords and empower them with financial strategies to help them save money, decrease the income taxes that they pay, lower the interest that you pay the banks, and redirect all those savings towards your lifestyle or towards paying off your owner-occupied home mortgage 8 to 12 years earlier than planned. Thank you so much for listening. Until next week, take care, my friends. Bye now.